Welcome. This video will explain how to use a pledged asset to reduce a mortgage down payment. So sit up, get your jotter and pen, then listen up. A pledged asset is an asset you offer as collateral to a lender in place of or to supplement a traditional down payment for a mortgage. This strategy allows borrowers to reduce or eliminate the need for cash up front while still meeting lender requirements for securing a home loan. We'll break down how it works, its benefits and potential risks. A pledged asset can be any financial or tangible asset with value, such as stocks, bonds, or mutual funds, retirement accounts, though these may have restrictions or penalties, certificates of deposit, CDs, real estate or other high-value possessions. By pledging these assets, you agree to allow the lender to claim them if you default on the loan. Importantly, you often retain ownership of the asset and may continue earning interest or dividends from it. Now, double your attention please. Steps to use a pledged asset to reduce a mortgage down payment. Assess your financial situation. Identify assets you can pledge. Stocks, bonds, and other liquid investments are the most commonly accepted types. Evaluate the current value of these assets to ensure they meet the lender's down payment requirements. Shop for lenders. Not all lenders accept pledged assets as collateral. Look for lenders that specialize in this type of mortgage arrangement. Confirm the types of assets they accept and their valuation method. For example, market value versus discounted value. Appraise the asset. The lender may require a professional appraisal or valuation to determine the pledged asset's worth. For financial securities, the lender may discount the value to account for market volatility. Negotiate the loan terms. Finalize the details, including how the pledged asset affects the down payment and interest rate. Ensure you understand restrictions on the asset while it's pledged and the conditions under which the lender can seize it. Sign the collateral agreement. This legally binds you to the terms of the pledge, including asset restrictions and potential forfeiture in case of default. Monitor the asset. Stay aware of fluctuations in the value of pledged assets, particularly if they're tied to volatile markets like stocks. Lenders may require additional collateral if the value drops significantly. Or you think all I've been saying has no benefits? Definitely, it does. Benefits of using a pledged asset: preserves cash flow. By pledging an asset, you can conserve cash for other purposes such as home improvements or emergency savings. Avoids mortgage insurance, PMI. If the pledged asset covers the full down payment, you may avoid private mortgage insurance, which is typically required for down payments under 20%. Retains asset ownership. You continue to own the pledged asset and may earn dividends, interest, or capital gains from it. Potential for better loan terms. Offering a pledged asset reduces the lender's risk, which may help you secure a lower interest rate or better loan terms. Okay, that's all. Thanks for watching. Kindly subscribe to our platform.